In 2025, Warren Buffett is worth roughly $142 billion, yet despite this, he is still paying a lower tax rate than his secretary. Hi, I'm Karlton Dennis, a licensed tax strategist. In this video, I'm going to explain exactly how rich people like Warren Buffett avoid paying taxes and how you can too if you mimic these strategies. I'm also going to answer a question from a subscriber at the end of this video, so stay tuned. All right, guys, one of the absolute most important reasons why the wealthy are able to pay lower tax rates than people with lower incomes is because they tend to generate a substantial portion of their income through long-term capital gains. Long-term capital gains are capital gains that you make by selling capital assets such as your stocks, bonds, or precious metals, even real estate, at higher prices than you bought them for after holding on to them for at least 1 year. So, for example, let's say you bought $100,000 worth of Apple stock and sold these shares 2 years later for $200,000. Pretty good gain. In this case, you would have a long-term gain of $100,000 because you sold your shares for $100K more than what you bought them for. And because of this, you get to experience something that's incredible. You get to pay long-term capital gains as opposed to ordinary income tax rates, such as income from a W-2 job, like the income that Warren Buffett's secretary earns by working for him. You see, the top capital gains tax rate is just 20%. However, the ordinary income gains tax rate is 37%. And before the Tax Cuts and Jobs Act in 2017, it was 39.6%. So as you can see, by having a large portion of your income taxed at capital gains rates, this could easily reduce your tax bill. Keep in mind that capital gains are not taxed until the asset is actually sold. When the underlying asset is sold at a profit, the gains become realized. This is important because it means that a millionaire with a large stock portfolio could actually have $1 million worth of capital gains per year without owing any taxes on them. He or she would only owe taxes after the assets are actually sold. You can replicate this strategy by buying capital assets such as stocks, bonds, real estate, precious metals, and Bitcoin, and holding on to them for longer than a year. Many people become millionaires through a combination of having these capital assets appreciate and paying extremely low tax rates on their capital assets that they sell. So if you're not an investor currently, you should strongly consider becoming one as soon as possible. Now we need to get to strategy number 2. Borrowing against assets. Many wealthy people take the tax benefits of capital gains income one step further. Instead of selling their assets and realizing capital gains, they actually use capital assets such as stocks as collateral to acquire massive loans from banks. And the reason why they do this is because the loans give them access to capital that they can use to fund their lavish lifestyles. However, loan proceeds are not taxed, and this is because the government does not consider a loan to be income, since it has to be repaid. The second benefit of this strategy is that because they are not actually selling their underlying assets, the assets can still appreciate in value, which allows a person to make even more money year over year. Now, to understand how this works, let's take a look at an example. I'm going to use Elon Musk because he is one of the best billionaires at this strategy. Let's say that Elon Musk, the world's current richest man alive, needs $1 billion to fund his lifestyle. He owns over 700 million shares of Tesla stock, which is currently valued at around $250 per share. Instead of selling the $1 billion worth of Tesla stock, which has been appreciating substantially over the last 5 years, he calls up the bank and says, "Can you give me $1 billion loan? I'll offer you $1.3 billion of Tesla stock as collateral." The bank says, "Sure, no problem." Why wouldn't they? Elon Musk's Tesla stock is excellent collateral. It's not a very risky proposition for the bank. Plus, Elon is putting up significantly more collateral than the value of the loan. Once the loan is approved, Elon has access to $1 billion worth of capital that he didn't have to sell his stocks to acquire and that he doesn't owe any taxes on. If he had tried to access this much capital by selling $1.3 billion worth of stocks, then he would have to have owed $260 million in long-term capital gains taxes. Now, he gets to avoid $260 million in long-term capital gains taxes and keep his $1.3 billion in Tesla stock that can continue to appreciate over time. If his stocks doubles in price over the next few years, he will benefit from all of that price appreciation as opposed to missing out on it and avoid capital gains taxes. Now, you might be wondering, Karlton, wouldn't Elon Musk just have to repay the loan? The answer is yes. He would have to repay the loan, but the loan could be repaid with very slow minimum payments over many years, even though he would be able to access the $1 billion worth of capital tax-free today. Also, the loan could become significantly easier to pay off in the future if the Tesla stock keeps appreciating over time, couldn't it? Another thing to consider that a lot of wealthy people choose to do is to refinance the loan when they come due as opposed to paying the entire loan off. See? Now you're wondering, Karlton, how can I do this too? You see, this is how people can avoid taxes entirely. Having money in stock options, taking loans against their stock options, knowing that the loan's about to come due, but then refinancing the loan. Oh, there's a tax provision called step up in basis. What's that? Let's talk about it. If you have never heard step up in basis, it is a tax provision in which the cost basis of an asset is stepped up to the current value of the asset once it is passed on from one person to their heirs during death. This provision prevents heirs from owning capital gains taxes on the assets that they inherit, and many different assets qualify for step-up in basis, including both stocks and real estate. So it is a common strategy for the wealthy to use assets that qualify for a step-up in basis to pass on wealth to their loved ones, such as their children after their deaths. This prevents their children from getting saddled with massive capital gains tax bills right after their parents die when they're grieving. Now, to understand how this works, let's go back to Elon Musk, for example. He took out that $1 billion loan using $1.3 billion of Tesla stock as collateral. Let's say by the time that he dies, that $1.3 billion is worth $10 billion. Well, when he dies, the balance on the loan would have to be paid off. Makes sense. But his children would inherit the rest without owing capital gains taxes on the many billions of dollars of price appreciation that the stock experienced during the rest of Elon's life. Instead, the cost basis of the Tesla stock would be stepped up to the $10 billion that it is worth today. Elon Musk's children would only owe capital gains taxes if they sell the stock later on for an amount higher than the stepped up basis when they receive the stock. Whew. So using collateralized loans to delay the selling of capital assets can also help wealthy people to transfer a large amount of wealth to their children as well. It's like wealthy people love debt. Many wealthy families are well aware of this and is one of the many strategies that they use to preserve their wealth over generations. Let's move on. Let's talk about real estate investing. Real estate investing is another powerful strategy that the wealthy use on a regular basis to dramatically reduce their tax burden. I'm going to beat this one into your head. There are a number of reasons why the wealthy are drawn to real estate investing. Some of these go beyond tax benefits. For example, real estate in America tends to just appreciate in value over time. We know that. This makes real estate an excellent inflation hedge and a great store of value. But rental real estate also produces cash flow in the form of rental payments, which we love, and having consistent, stable, passive income is a great way to build wealth over time. Real estate investments can also be made using leverage through mortgage loans. This allows real estate investors to get access to extremely valuable cash flow producing assets without having to spend all of their hard-earned cash up front. Only a cash down payment is required. So there are many great benefits of real estate investing besides tax benefits, but real estate investing does have incredible tax benefits. So let's talk about them. One of the best tax benefits of buying real estate is that you get to take a write-off for the entire value of the structure over time. Let's say, for example, that you buy a rental property worth $2 million. Of this $2 million, $1.5 million is the structure, the other $500,000 is the land, okay? So in this case, as a real estate investor, you would be able to deduct the $1.5 million of the building structure. You're not able to deduct the $500K of land because land does not depreciate. So in this example, if your rental property is a residential property, the depreciation timeline is 27.5 years. If it's a commercial property, the depreciation timeline is 39 years. You can use a cost segregation study to accelerate the depreciation timeline, meaning you would be able to claim more depreciation in the first 5 to 7 years of owning the property as opposed to having to wait 27.5 years or 39 years if it's a commercial property. Now, if you want to learn more about cost segregation studies and how they can affect your depreciation deduction, then check out our cost segregation study calculator. There is a link in the description below this video that will take you to our cost segregation study calculator so you can play around with it. Now, in addition to being able to get massive depreciation deductions, real estate investors can also qualify for many other tax benefits, including being able to write off repairs and maintenance, the mortgage interest, the property taxes, their management fees. They can write off their travel. Even if they have a car that's used for managing. But real estate investors also can use the short-term real estate strategy to offset W-2 and 1099 income. And this strategy alone can potentially reduce total tax burdens by 50 and sometimes upwards to 100%. It is incredibly powerful and one of the main strategies we leverage at Tax Alchemy. If you want to learn more about this strategy, if you're W-2, you're a doctor, lawyer, physician, you're making a lot of income, this is a strategy I would highly encourage you to inquire about with my office. As mentioned earlier, real estate assets also get the step up in basis. So when you transfer the asset after death, your heirs will receive a step up in basis similar to stocks. People use real estate to build and preserve generational wealth. All right, guys, as promised, I'm going to answer a question from one of my subscribers. This question was asked by Adia5431. Sorry about that. On my How Real Estate Investors Get Into the 12% Tax Bracket video, the question was, what happens after the first year of accelerated depreciation? Don't you just end up back in the normal tax bracket in year 2 and beyond? This is a great question. If you're somebody that invests money into real estate, and you know that you're going to be able to qualify to take advantage of the cost segregation study. So you're forcing this paper loss that can offset active forms of income, W-2, 1099. Why would we take the tax savings and do nothing in the following year? We're just going to go back to the tax bracket that we're in, make more money, and not buy another investment property. Most savvy real estate investors will take those tax savings and then reinvest into another investment property. But here's what I want you to also understand. Just because you accelerated depreciation in the first year of owning the property or within the first couple of years of owning your property doesn't mean that in the following year, you're not still benefiting from doing the cost seg. When you do a cost segregation study, you're accelerating depreciation and front loading it, but there's only so much of it that you can take in the first year that you perform the cost seg. The second, third, fourth, and fifth year are still very strong years for the cost seg to have a big, meaningful impact on your tax return. So please don't discredit that. Even though you're going to receive a lion's share of the savings in the first year, the first 5 years of having that cost seg on the tax return are massively beneficial. So if you take the tax savings after that first year and reinvest into another property in the second year and another property into the third year, by the time you get to the third, fourth year, you're sitting on a couple investment properties, but you have rollover depreciation that's been stacked up now. You eventually can get to a point like some of my clients who have invested for years where they have so much depreciation rolling over that we don't even technically need to buy another investment property because they have so much non-used depreciation that can be used in the current year to offset their active forms of income. I hope this helps. Thank you guys so much for watching this video. You know what to do. Like, comment, subscribe, and I look forward to seeing all of you guys on the next video. Cheers.